Hi, good afternoon and welcome to the Market Wrap for week ending 25th of June 2021. Stuart Williamson here, APW at the helm. Okay, this week we're going to talk about the latest market data and is it a bubble or not? Okay, if I get asked if it's a bubble or not, this week, I think I will probably explode, let alone the bubble. So, what are we going to talk about? Okay, UK housing market figures according to Zoopla. And I quote, buyer demand set to ease as the economy opens up, but it will remain elevated compared to previous years, which we anticipate at Zoopla will be one of the busiest sales markets in more than a decade in 2021. Okay, what is the underlying fundamentals there? Okay, sales completions reached 1.5 million for the year, which is up from 1.04 million for last year. And it's the highest in 10 years. Highest in 10 years, which is very good. Supply and shortage. Housing stock is down 20% on this time last year. Why is that? We covered it to a large extent last week in the talk about the supply of building goods. Everything stopped a year ago and it's been very slow to catch up. But bizarrely enough, it's very positive for the UK economy from a building perspective, because I was talking to a builder this week and he said for the first time in his memory, they're making doors again in the UK. He said he just invested in a part of electronics business because it's becoming big business again. And because you can't get Italian white goods very easily, then they're using alternatives, which a lot of them are UK made. So it's very positive for the UK property market and the UK economy in general. Who are the best price growth areas? If we got across the UK, we're at 4.1% on average. The biggest winners are Wales at 6.3%, Yorkshire and Humber at 5.4% up. Biggest loser is London, only at 1.9% up. Individual cities, who's doing best? Liverpool and Manchester at the top again, 5th month running. Again, what is that based on? It's based on availability of stock. If people are buying in an area and it's going crazy, then the more it goes up, the more they want to buy and the more the stock will disappear. And that's what we're finding in Manchester and in Liverpool. Even though a lot of the stock that's for sale, frankly, I think is not that good and I wouldn't buy it myself, people are out there buying it. So Liverpool and Manchester are up there. The other people who've got 5% plus growth figures are Nottingham, Leeds, Leicester and Sheffield. So still some good growth in good growth locations. Over and above that, types of demand, houses are going up 4 times more quickly in price than flats. Again, why is that? It's a lack of supply. There's not enough houses around, there's enough flats. So house prices are going up strongly. Okay, overall summary is demand levels have moderated since Q1 as the economy opens up. There's still a lot of people out there thinking of moving. Apparently there's quite a big movement in the older community, people who haven't moved for 20 years plus and thinking, well, I want to change my lifestyle, I want to move. The workplaces are starting to open up now and say, okay, for sure we're going to need you 2 days a week instead of 3 days a week or 5 days a week. So it's going to lead to a lot more movement to accommodate with that. The stamp duty holiday is ending. It'll go down to 250,000 as of the beginning of July. The market is still going well. However, it's the undersupply that's causing it to do that. Plus the pent up emotions and the pent up frustrations of not being able to make a decision because of A, the Brexit referendum, and then B, COVID. So it's people getting frustration out of their systems. Interest rates could well start to go up. It's talking about inflation going up. There's a lot of talk this week about, is it a bubble? Now, if you get an opportunity, try and listen to the Knight Frank Intelligence Talks. They come out every Friday. It's a podcast. This last Friday, one came out, and the gentleman on it is a well-known property guru. His name is Savvy Savouras of the Tosca Fund, and his fund has got 2.5 billion US under management. And he says it's not a bubble. It's a strong market for these reasons. The fundamentals are sound in the UK. It's got the strongest economy of the G7. Inflation will come and it will be between 2 to 3%, but wage inflation, and this is crucial, wage inflation will be higher than that. We've already seen wage inflation of 4% for the first quarter in 2020 compared to 2019, so it's 4% up. This will lift disposable earnings and keep mortgages affordable. That's the key part. The mortgage market is far more sophisticated than it's ever been in the past, certainly than 2008 when the last crash occurred. Plus, back then, we started off with high interest rates. Now high interest rates may come, so it's a different ballpark again. Okay, house price income ratios are at acceptable levels. And a house price to income ratio, I had to write this down, is house price divided by income equals the ratio. Okay, at the moment on average in the UK it's about 8.5, 22 in Westminster, 3 in Burnley, but 8.5 on average. And that is an acceptable house price ratio. More interesting facts. Capital repayments on mortgages now are the same percentage as a percentage of income that they were in 2008, when house prices were £180,000. Now they're £268,000 on average. But the capital repayments as a percentage of income are the same. So it hasn't become any more expensive from a purchasing perspective. It's still the same. Now there's more equity in properties in the UK than there ever has been before. Okay, those are amazing statistics. It's still capital repayments are still the same as they were in 2008. House prices, though, are 50% more expensive. And equity in properties held in the UK now is the highest it has ever been. Finally, he says interest rates will rise. In 2 years, it'll be at 1.75%, but they will be affordable because of wage inflation. That's it for this week. It's not a bubble. It's a consistent and growing market that will carry on for the foreseeable future. It's a great time to buy. Thank you very much for listening. Cheerio.